All right, guys, welcome back. We are going to look at our wheel strategy account here. This account, we're taking $10,000 and seeing what we can do with the wheel strategy, selling cash secured puts and covered calls. So if you watched the last video, we opened up 3 contracts at the beginning of the week that expired today, which is Friday, and we're up 1.23% on the week, $123. Pretty nice return. Not sure if we'll be able to keep up that standard of percentage, but if we can, that will be pretty awesome. And I'm probably do this with more money. That's the case. But yeah, if you look at basically 1.2. So yeah, 1.23% times 4.92% times 12, 59% in a year, if I'm doing that correct. And then do 10,000 times 0.59, that's $5,900 in a year on that 10,000. However, it will be compounding because every week if you're putting back in that same amount, so it'd be 5,900 if you took out your profits each week and just use the 10,000 as collateral, or to sell puts with. So basically, if you keep reinvesting your earnings, this will compound very quickly. At 1.23% a week, it will be because in a couple weeks you're gonna have, so let's see, we have $123 a week. Next week you're gonna be, I don't know how to do that math, but I'm not a mathematician. Anyways, it's going to be a lot because you're going to be compounding it, which you don't have to. You could just take it out and just play with the 10 grand. But anyways, let's get into the plays that we opened up. So Under Armour, we still have this one, and it will expire on next Friday. But what expired this Friday, we opened up. We'll started with Cinemark, which so we opened up this one. Yay, yeah, rocket. So we opened up a contract for $46 for Cinemark. If it expired at $7.50, they paid us $46 premium. If Cinemark was below $7.50 by next Friday. So basically Cinemark happened to shoot up after that, which caused this contract to lose value really quick, which isn't typical, but it happened. So we were able to get out of it. We were able to buy the contract back on November 2nd, which was last Monday. Let's see if we already buy it. No. It closed out on November 9th. Okay, this one. So this Monday, after Cinemark shot up, this contract was worthless. It was basically only worth $5 instead of the $46. So on this play, we made $39 in just that week of time with only $750 of collateral because the share price was $7.50. So to buy 100 shares, it'd be $750. So that one was complete. That was the first one. And then here was the next one. It was on DraftKings. So I opened up one contract for $32 a contract, and this was saying DraftKings was going to be basically above $36 share price by today, this Friday. And then as the day progressed, DraftKings went down in value, or the share price went down in value, so the put contracts went up in value. So when I sold this put later in the day, it was more valuable because the share price had gone down. So I sold this one for $40 a share, or 40 cents a share, which is $40 because 100 shares. So total, this was $40, $50, $60, $72 in premium that we got from selling these 2 puts. And those expired today, and they expired out of the money. So they didn't close. I didn't buy them back. They just expired out of the money. I thought I had an order to buy them back, but I'm not sure. It's not showing it here, so maybe I didn't. But if you look at DraftKings, so basically it was $36. So DraftKings at $42. We opened it on the 9th. It was $42, opened on the 9th. there was some volatility in it. So that's when you get, you know, premium basically on contracts. So that's how we're able to get that much premium for $36, which wasn't too low, but it had been going down. I guess not too much here, but it's been having a long streak down for a while. So there was basically still sentiment that it was going to go down to $36. At least the amount of premium that we collected there was. So it went up today, and it didn't really matter even if it went down, as long as it didn't go past $36. That contract would have expired worthless, and we would have not ended up with the shares. So basically we got our collateral back, and we kept, you know, you keep the credit either way, but got our collateral back, and yeah, and this play expired worthless, so that's what we want. Rocket was the other one that we opened up. Let's see, what was it? On November 10th. I did that on Tuesday. Oh no, that was to buy it. I'm sorry. So confusing. Okay. November 9th. Yep, on Monday. Sold a put on Rocket. Basically that Rocket would stay above $18.50 by today, Friday. And I got $50 for that contract to sell that. And then I usually put an order out the next day, not the same day, because then you're a pattern day trader if your account's too small. So the next day I put out an order to close it, or buy to close the put that we sold. So you're selling a put, and then to close it, you buy it back. You don't have to close it, you can just let it expire, but you buy it back so that you can get your collateral back to open up another position. So in this case, or in basically all the cases, once I've opened one up, watch the last video on this in this playlist on wheel strategy. You'll see once I've opened a contract up, once I've sold a put, the next day I will buy to close, and I'll just put the minimum amount, and then I'll put the expiration for that order to be good until canceled. So as you see here, that is that order. So we received the order to buy to close. This was after I already had sold a put. Buy to close one contract of RKT at $18.50. This was the put that I had already seen, 1 cent per share. So basically to buy it back for $1. So yeah, so you're taking a $1 hit, when if you just let it expire, you would have kept that dollar potentially. But and then it says, hooray, your order to buy close. So this did get filled. Looks like it got filled this morning because RKT had earnings and it beat expectation by 13%. That's crazy they put that in here, but it went up enough that it got filled right at market open. So if I was on it and I needed that collateral back, I would have put it back out. I didn't really need it, so it didn't matter, but I was fine to spend that dollar anyways, because sometimes you want the collateral back so you can open up another position right away. So on this one, yeah, we got $49 from that one, and then that was in that week. And then from this one we got, let's see, this was 32, 40, 56, 72, and this just expired worthless, so I didn't pay to buy it back. 72, 42, and that's how you get your 100 and whatever it was this week, 125, because we also have the U Under Armour. So this one's still open. So this expires next Friday. If Under Armour shoots up, my order here, I don't even have it. I'll put one in right now. So this is what I'm talking about. I have negative one contract. That's very confusing, but basically I have one contract that I sold. That's, I guess, why it's negative, but I sold a contract, a put. So to close, I have to buy it back. And actually, yeah, on Under Armour, they only go in 5-cent increments. So this one, since it's only $20 credit that I got to sell it, I probably won't buy it back for 5 cents because that's just too much of the profit. So I'll just let this one expire. But if this could go in 1 cent increments, I would put in an order for 0.01. I would change the expiration from good today to good till canceled. Then you have 90 days, and anytime it can, it'll execute it. But it has to be, it'll be during market hours. But then you don't have to think about it. So I review order, and then it says, oh, it's got to be increments of below 3, increments of 5, all this skimming stuff. So I'm not gonna do it on this one. But then once it executes, it'd be I get my collateral back. So this one's still in there. But if you look, so the buying power is only 1,800. That's because the DraftKings expired out of the money, but it's gonna take time to settle. Whatever, it'll show up in the account by Monday morning. Well, probably by tomorrow, actually, Saturday. And then, yeah, by Monday, we'll be able to sell more puts. I'm not sure what I'm going to sell next week. Hopefully we can keep up some kind of consistency with the percentage a week, and we can get averages and see how that works. I'm sure there'll be times when we're selling puts and the share price will drop and we'll get exercised and we'll own 100 shares of this and have to wait on it and sell covered calls. And that's just the way it works. But I'm not really doing specific deltas for this or that and trying to say sell put with 0.20 delta and sell covered calls with 0.30 and different. At this point, I'm not. Maybe at some point I will, but right now I'm just kind of looking at technicals, looking at support and resistance, looking at averages, looking at stocks that, first of all, we can afford to sell puts on, and also ones that maybe you wouldn't mind owning at the price that we're selling puts on for. So pretty far out of the money ones that probably won't get exercised, but we'll see. Sometimes I might risk it more if I think that it's coming down to a hard support or it's at its support and on its way up. I'll try and sell puts when the share price is coming down, just so we'll get more premium, but I might sell puts when it's a green day and there's momentum going up, just because I know as the share price rises and it rises quicker, that contract will lose value quicker and you'll be able to get out of it sooner. So there's that also. But yeah, now it's saying 1.25. Did Unmurmur just go up? That's weird. But anyways, yeah, so 1.25. This is basically where we started on Monday. We started, and see this huge dip right here. You gotta just, with these plays, you just have to kind of sit through it and just wait. Like there's not a lot of trading. That's what's nice. It's kind of a hands-off thing. You don't have to do much. If the share price goes way down past your strike, don't worry about it. It'll come back up. If it doesn't, whatever, you'll get exercised. You can do other stuff. You can close it out for a loss if you want, or I don't know, roll it over maybe. I'm not gonna be doing that stuff. I'm gonna try and keep it simple. Not try and do a lot of trading with it. Big problem traders have, or people investing in the market, is they just overtrade. So this strategy, you really don't need to overtrade. It doesn't help you. It just keeps you patient. The way you make money is with time. You're basically leveraging your money and your time to get a return. So you're letting other people use your money. You're basically the bank. And you're collecting more or less high yield interest to collateralize your money. So you don't need your money right then. You put it out there and you can make money back just by letting them use the money. So more or less that's what it is. This keeps going up. Oh, past month. Okay. Like, why is that 1.96 now? Okay, 1.25. So I don't know how to do this math. Tell me how to do it in the comments. If it's 1.25%, so on $10,000 times 0.0125, right? That's 125, right? So if we had 125 plus 10,000, that's 10,125. So next week, 10,125 times 0.0125 equals 126. That's plus I don't know how to do this like the proper way. Plus 10,125. See what I'm doing here? And this is compounding. So if you leave your money in and keep using it to sell puts and sell covered calls, this is going to compound. So what did I do? So 125. Then we're at 10,251 by next week. Oh, we're already at 10,200. Okay, well that times 0.0125 plus 128, and then that's plus 10,000. 10,251. No, don't do that. I'm hitting enter. I'm getting confused. Basically, it's going to compound. I don't know. Tell me how to do it. Anyways, that's it for today. Monday, we're going to sell some more puts. I don't know what exactly on yet. We will see. Hopefully, we can keep up this percentage. Maybe we can make it better. Maybe we can make 2% a week. That's pretty aggressive, I know, but I don't know. Maybe it's not aggressive. Some people try and make 50% in a day. So 2% a week is good. That's good. I'm stoked. If you guys like this, make sure to sub up, like up, comment down, make your money happy money so it'll stick around. This account, this video, and I'm gonna have all these videos on the same playlist. So if you missed the first one, go back, watch that one. I explained wheel strategy in depth and kind of what we're gonna do. But yeah, I'm taking this $10,000 account and we're just gonna see what the wheel strategy does with it, and picking stocks and at prices that I'm familiar with and that I wouldn't mind owning at. So trying to find stuff that's somewhat volatile so you have premium. You know, that's why I kind of picked DraftKings and stuff we can afford too. It's got to be pretty cheap, right? Because it's got to be less than $100 a share. It's only $10,000 account. So something like AT&T doesn't have any premium. So I'm like, okay, AT&T is a slow mover, which is nice and safe. But if you sold a put on AT&T, you know, this is close to the strike price, real close, $28. It's at $28.90, only $7 in premium, and then you're taking up $2,800 of your collateral. So that, you know, I probably won't do stuff like that. That's a safer way to do it. I guess I'm trying to find a kind of a spot where it's safe enough. But sometimes it'll be more aggressive if I think the stock is at a support level and it's going to go up, or the put that we're selling is so far out of the money that I'd be fine to own it. You know, follow along. Let me know what you guys think. Have a good weekend. We'll see you back here on Monday. Probably do 2 videos a week on this this playlist and these wheel strategy, and then every day, of course, we'll do our daily recap with buying calls, buying puts, credit spreads, swing trading, day trading, shares, you know, all that stuff. So thanks, guys. We'll see you next time. Peace out.